Hello, this is Tom Wallace. I'm the managing partner of Florida Funders, and welcome to Florida Funders Angel Investing in Florida podcast. For those of you who are new to our podcast, we do these a couple times a month, and we go out and look for experienced and interesting investors, and we interview them because we think we're all in this together and we can all learn from each other. For those of you who are not familiar with Florida Funders, we're a hybrid between a venture capital firm and a crowdfunding platform. So we're always scouring the state of Florida, looking for the most exciting new companies coming up and investing in entrepreneurs and helping them to, we'd like to say we're finding, funding, and building the next generation of great tech companies here in Florida. We do some investing outside of Florida, but we're pretty much Florida centric. And a lot of the companies we invest in are either, if they're not headquartered here, they're coming here or have a significant presence here. We'd like to say we're on a mission to change Florida from Sunshine State to Startup State. And I'm really excited about our guest today. And our guest is joining us from New York City. His name is David Goldberg. David, welcome. Excited to have you on the show. And why don't you tell our audience about your background?
Hey, Tom, thanks for having me. So while I am normally in New York City in this COVID time, I'm actually bunkered down in the suburbs of New Jersey.
Okay.
Very exciting. So my background is probably one of the more random trajectories into venture. So I started my career coming out of both law school and business school as an assistant district attorney in Brooklyn, New York.
Wow.
I was a criminal prosecutor, which when we have more time another day, I have some really interesting stories I'm sure I can share with you.
I'll bet.
Yeah. From there, I went more into traditional finance, spending a couple years at Merrill Lynch, then one at Jefferies, the global investment bank. While at Jefferies, I started what at the beginning was really more of a side project and turned into my full-time gig, a startup called Freshneck, which was a collaborative consumption men's fashion sharing company. So we basically rented out on a subscription basis all types of men accessories that didn't have a fit component. So ties and bow ties, pocket squares, watches, jewelry, sunglasses, ultimately building that business for a little over 3 years and selling it in 2013. From there, I got pretty deep in the New York tech ecosystem and startup ecosystem. It was a lot smaller back then. Got to know really people on both sides of the table, founders and investors, ultimately meeting my now partner, Ryan Friedman. And we really had the vision for building out the type of venture capital firm that we wish we had partnered with as first-time founders.
Oh, okay. And how long have you been, it's Coragem Ventures, right?
Coragem, that's right.
Coragem, I'm sorry. So when did you start Coragem Ventures? And, what size fund is it, and what kind of investing you guys do?
Yes, I think it's 2 weeks from now will be my 6-year anniversary. So we started investing in early mid 2014. It was mostly GP capital. We carved out $20 million, more of a proof of concept. We then launched a traditional outside capital fund in 2018, did our final close in 2019. And ended up at $36.5 million. So we're about halfway deployed through that fund right now.
And what kind of tech investing do you guys focus on? What would you say is your sweet spot?
Sure. So early stage only and really predominantly seed stage. So we like to be the first institutional check anywhere between $750K and $1 million in what today is a $2 to $3 million seed round. It's very active, hands-on, we'll set terms, take board seats, and really be sort of the first phone call at the table. We like to invest in companies that we consider are reshaping the real world. So things at the intersection of the digital and physical world. So consumer products and services, marketplaces, e-commerce infrastructure, supply chain, and real estate technology.
And do you focus just in New York City or do you?
No, we'll invest really anywhere in North America. Now, just given proximity and networks, I'd say about 50% of our portfolio, which is now 56 companies, hails from New York. Our two second biggest markets are Los Angeles and Boston. And then there's a couple in San Francisco, and then some one-offs in Chicago, Minneapolis, including one in Florida.
Okay. Where's the one in Florida? I'm just curious.
Class Wallet.
Oh, Class Wallet. That's right. I knew that. We're in that deal too. We share together. So you're looking at deals a lot. And so how many deals do you look at for everyone that you decide to fund?
Oh,
Would you
man.
say?
So last year we looked at 1,450 deals and we did 8 or 9. We have added also a third partner. So that number could easily jump closer to 2,000 and maybe we'll do one extra deal. So, you can do the math. It's a pretty tight funnel.
So you're obviously very, very selective, and you know what you're looking for. Talk to us about that. Is it you're doing early stage stuff? I'd like to understand how early are you doing pre-revenue deals or not so much, and then what are you looking for, in these very few that you select to fund?
Yeah, so in terms of stage, like there really isn't too early for us now. There's also a balance between the experience of the entrepreneur and how early they are, right? The better the entrepreneur, the more experienced he or she is, the more risk we're willing to take and take them a little bit earlier. Whereas maybe if you're a bit younger, first-time entrepreneur, we'd want to see a little bit more fleshed out, though we don't need, revenue or certain traction on that sense. What we do like to see, though, is a pretty fleshed out vision around the product and most of the core team already locked in to be ready to go full time. We're not really investing in too many solo founders who have not built out any type of team around them.
And what do you look for in those solo founder or teams? What do you look, especially the founder or co-founder? What do you look for in those folks?
Yeah,
Go ahead. I'm sorry.
It's really hard to nail it down to one thing. It's all the obvious things, right? You want smarts, you want drive and hustle and perseverance. But I'd say really where we probably lean in a little bit heavier than some other firms is understanding the specific advantage that this entrepreneur has in the specific market that he or she is tackling. Now that can come from a unique insight from past experience. Maybe he or she worked at a customer or an incumbent in the space, but something that they're able to take with them that gives them a competitive advantage over all of the other incredible entrepreneurs that are out there, likely working on something similar.
Yeah. So maybe give us an example of a deal you did recently and what you found very attractive about that particular founder or founders.
Sure. So one investment that we did a couple of months ago is a company called Arrive Outdoors. They're a Los Angeles-based company. They are an outdoor gear rental company, right? So if you want to rent camping equipment, skiing equipment, something along those nature, instead of buying it and spending thousands of dollars and lugging it to a camping site or a mountain, you can rent it, have it either shipped to your home, your Airbnb, or maybe to the actual grounds where you're going to be. Now, a broader theme that we've been thinking about really for about 2 years now is thinking about consumer companies that have non-direct-to-consumer distribution channels, right? As we've seen acquisition channels rise through Facebook, Google, and the like, looking for proprietary channels. So in this case, the CEO really had a background and a superpower in B2B partnerships. So here, the competitive advantage wasn't knowledge around camping or skiing, but it was the strategy as well as the traction in building out some of the partnerships where they can get proprietary and often exclusive distribution through either the camping ground or ski mountains themselves.
So he had some deep domain expertise and connections within the industry.
She.
Sorry.
Yes. Yep.
Good. We share we mentioned we share Class Wallet as a portfolio company, Florida Funders, and Coragem. Did I say it right that time?
Coragem.
I'm sorry.
RG, like the drink.
Okay, Coragem. Hey, I'll remember that. You know me already. So Class Wallet, what got you excited about Class Wallet, and what do you think about that company?
Yeah, I think ultimately every investment really starts with two things. It's a market that has clear problems and opportunities, and then a founder who checks all of the boxes, is really passionate, really knowledgeable about their space, and someone that we are proud to partner with, for 5 to 10 years. And I'd say kind of right off the bat, Jamie, as the CEO and founder there, was someone that checked all of those boxes, and we were excited. He understood that market better than most, even better than us. I think that was an interesting investment and still proves to be, in that we knew there was an issue. We knew there was a problem. We knew they'd be able to really get into that ecosystem and have a lot of spend take place on their platform. I think the real question, and still today that still needs a little bit more fleshing out, is how well can you monetize that, right? There's sort of are you solving a problem? That's level one. Number two, can you then turn that into an incredible, scalable, profitable business?
Yeah. Just for our listeners, Class Wallet is in the education space, and they provide a way for teachers to buy school supplies and all that through a virtual wallet, so they don't have to save receipts and then turn them into their office to get reimbursed. And Jamie is a great founder and CEO. It kind of gets me thinking about, these times we're in, the COVID crisis. I mean, obviously this has affected some of our portfolio companies. I'm sure some of your portfolio companies, and we've been working with our portfolio companies to try to, figure out how they best navigate this new post-COVID, the new norm, whatever the new norm is. I don't think any of us know, and certainly a company like Class Wallet, who was in the education space, all our schools got shut down, were dramatically affected by this. I'm kind of curious as to, your take on what you've done with your companies and how many of them were affected positively or some negatively, and, kind of how you guys are navigating through these unprecedented times we're in right now.
Yeah, sure. So we spent really all of March doing triage, right? And we spent the first week or two with our own internal operations, made sure that, we're a 6-person team now, all remote, making sure that we're on the same page, we're communicating, we had our tech stack ready to go. And then we spent the next couple of weeks both informing and educating and helping our portfolio companies, as well as getting the knowledge internally so we can make strategic decisions, right? And that's everything from where do we get offensive in terms of buying up ownership in companies that just want a little bit more security and runway. Where and how do we reserve some capital to get defensive for maybe some of those that are really struggling right now but need a little bit more time, but we ultimately think the long-term prospects are still there. And then also, where do we have really hard discussions with founders where there's just not going to be any more capital? And maybe that's because of company performance, or just the impact of COVID is too great for them to overcome. I think given our portfolio and the sectors we play in, we're fortunate enough that there's certainly impact, but it's not a portfolio-wide destruction. There's probably 5 or 6 companies in the real estate, travel, hospitality space that got hit a little bit harder. There's a couple in grocery delivery, alcohol delivery, telemedicine that are kind of having their moment.
Yeah, especially that alcohol delivery.
Yeah, I think
I gotta believe that's going really well right now.
They were actually on the news last week. I think they were up about 400% month over month, which is kind of crazy. But unlike a lot of e-commerce industries that are late to sort of move online, I think alcohol penetration is still under 10% done online. This has been a catalyst that they've been waiting for a long time. And then you have everybody else in the middle, where maybe they're flat, maybe they're down 20%, maybe they're up a little bit. I think they are actually thinking more about the fundraising environments in the next 3 to 12 months than they are about the actual revenue impacts on their companies.
Yeah, I think all of us are thinking about what the next 3 to 12 months are going to look like from a fundraising and investor standpoint, and a lot of unknowns there. I'm just curious, on our side, we worked with a lot of our portfolio companies on PPP loans, the payroll protection, the federal money that was available. And quite a few of our companies applied for that and got funding. Did you see the same with your companies?
They did, and we did a lot of education on that. So I think the first week of, call it, true COVID impact, when everyone was working from home, I believe it was the 2nd or 3rd week of March, we hosted a couple of webinars with partners at law firms and some CFOs to help them navigate. I mean, as I'm sure you remember, it was pretty confusing time for startups. Many of them applied. We did have a couple who either withdrew their applications or actually sent the money back after a little bit more guidance came out around what hardship, I think, really meant and potential liability. But ultimately, I think it also was a lifeline to a couple companies who really needed it to maintain the payroll, which is, these companies act pretty lean to begin with. So losing a couple people here or there can take a major detriment to the company.
Yeah. We worked with a lot of our companies on that. And then, and I'm sure you probably went through this when you were talking about the triage, really looked at, cash is going to be king. How much cash do you have? What's your runway? And can you cut your burn? And I'm sure you kind of went through that same thing with your companies. And a lot of our companies, did cut their burn and extend their runway, and the PPP loan, it'll be interesting to see how much they have to pay back. Because as you know, that the idea of that was not to lay people off and not to cut jobs. And to the extent that they use that, they did cut their burn. That part of the loan will not be forgiven, but still a very low interest loan. So that's kind of interesting. Talk to our audience. Tell us our audience about. I always like to ask this question, like, what are your big misses? Did you have a big miss? Do you have a deal that you passed on that you look back on and has done really well? And that always makes for some good fodder for conversation. Do you have any of those?
There are so many more to count, and just anecdotally, I know that there's even a ton that we barely even looked at that went on to kill it that I couldn't even remember. Like we'll be looking through Salesforce, we track everything. We'll be like, oh, wait a minute. We saw this company. They're now valued at a couple $2 billion. I remember one was Canva, the collaborative design company. I'm like, you didn't even give it the time of day. Obviously, huge mistake. And then there's a couple that we dug pretty deep into and ultimately made the wrong decision. One that comes to mind, where I actually I'm a happy customer, is a company called The Farmer's Dog. They were really one of the pioneers in, call it, direct-to-consumer, fresh, human-grade pet food. And really just an incredible business as we've seen the shift of really how people and families treat their pets more like family members. And as you can imagine, and I'm a testament to it, we've now had 2 dogs since I started being a customer of that company. It's like the metrics in the LTV of once you find something your dog likes, you do not get off of it.
Yeah.
I'd be afraid to tell you what I'm spending every month on my dog.
Well, my dog is actually sitting at my feet right now as we're doing this, and I'm definitely in that club. And Chewy.com is a great local success story here in Florida that came out of Fort Lauderdale, Ryan Cohen. That's a wonderful story. But, I just think I agree with you. The whole pet, that's a great space, and people, we will spend anything on our dogs. My guy's 12 years old. He just had his knee replacement.
I just went in a deep dive, both as a customer and an investor, into the pet insurance market. I got a puppy 10 days ago.
Oh, wow. What kind?
We lost our last one. It was a rescue that came up from Oklahoma. He looks to be some kind of shepherd hound mix. We don't know.
Okay.
But we got insurance because also for my last dog, I went through 2 ACL surgeries and cancer, and that can really add up.
Yeah, absolutely. Well, I think it's great you're rescuing a dog. Mine's a rescue as well. As we look at the world, the new world that we're going to be facing, this new normal, what opportunities do you see that presenting to you as an investor?
Yeah, it's a great question, and not to skirt it, but we're really trying to think about what will be a real shift in behavior and what will sort of go back to as close to normal as we remember it. And I think the jury is still out on that, right?
Mm-hmm. Sure.
One example is like, what does retail, brick and mortar retail look like? Like, what does travel look like? Now, I think over the next 3, 6, maybe even longer, it's going to not be a great space. It's going to be a very gradual back to normal if we ever get there. The real question is, a year from now, do we forget that this happened and people are out there shopping in stores and trying on things? Or is there a real shift to experiential, at home, different type of footprint, really something that I can't even imagine right now? So I'm really keeping open mind space for what does the new normal look like. I don't think it's where we're sitting today in COVID, and I don't think it's where we were sitting just a couple months ago. I think it's some hybrid in between, and it's going to be almost industry by industry. That being said, I think one of the spaces where there's been a shift that will only continue to go from here. One is around education, and that's both for sort of adults in the workforce, children, and sort of traditional college and everything in between, as well as remote work. I think we're going to start seeing a lot of tools and infrastructure and operating systems that will further catalyze what we're already seeing as people are opening their eyes and companies are opening their eyes. We're losing very little productivity, but saving a ton of cost and having a lot happier workers.
Yeah, that's interesting and fascinating. I agree with you. I think there's just even personally, I know that I tried Instacart very early on when they first came out. I hated it. It was, they got half my order wrong and took forever, and they charged me a lot of money. And I went back and tried it this time, and I'd be more inclined to use it in the future. And speaking of retail, I definitely see everybody sees the retail's challenge right now, and that challenge is going to be for a while. We have a company we are in the process of funding that helps high-end retailers, luxury retailers, stay in touch with their customers via text. And it's a very exciting technology. And their main target, you might find this interesting, and the audience might, their main target right now is jewelers, right? And you think there's like, I don't know, 10,000 independent jewelers in the United States or something like that. It's a very fragmented industry. And, but last month, this really surprised, and this is a small company. I mean, under $1 million in annual recurring revenue, ARR. But last month, think about selling to jewelers last month, most of them are all closed. They closed like $75,000 worth of new business. I was like, wow, So I think that, retail is going to change. I think, remote work, I agree with all the things that you said, and it's going to be really interesting. I think one of the things that we've looked at is, if you look at funds that started in like 2009, 2010, those vintage funds, they tended to perform pretty well or very well compared to funds that started in I'm using the last financial crisis. So I want to ask you about that. So do you think as an investor post-COVID that the pendulum is shifting? I've heard people tell valuations are going to be better. It's going to be, let's face it, for the last few years, it's been a very founder-friendly environment for raising money. Valuations have continued to go up and all that, as we all know. What do you think that looks like coming out of this?
So I think, and we've already started to see, valuations will come down a little bit. I don't think it will be drastic. And if you look at the data, there's been a ton of capital raised by venture capital funds across sort of the entire spectrum of seed stage all the way through growth capital. So there's a lot of dry powder out there, a lot of corporate capital, private capital. So you're still going to have a bit of that frothy environment, especially in the markets like New York and San Francisco. Now, what excites me about sort of what's, not that COVID itself is obviously exciting me, but one of the trends that we're seeing is sort of the further catalyst of sort of non-tier one tech markets kind of having their day, right? If I can't meet a team in person, if a San Francisco firm can't meet a team in person, then being there isn't as much an advantage. And maybe you'll see markets like Florida and Austin, which is making a bit of a resurgence, Toronto, get a little bit more traction in their sort of surge towards becoming real tech hubs. And I think part of what will come along with that is the lower valuations that are typically in the South, the Midwest, and really the non-coastal markets.
Yeah. Well, we're excited about that here in Florida, and hopefully that this benefits us. But I think what we've seen in Florida already is there's been, over the last few years, we're getting a lot more traction. I guess would be considered a tier 2 marketplace, and with things like Chewy and we probably have 7 unicorns across the state now. ConnectWise here locally had a big exit, $1.6 billion. Nobi4 is a unicorn here locally, cybersecurity. So we're seeing that, and I think the more we see that, obviously success breeds success. So we're excited about that. I'm trying to think of what, in terms of the investments you've made, and thinking of interesting stories. is there any investment, we talked about the misses, is there any investment that you've, I know you're only in it 6 years and you probably haven't had a ton of exits, but what is the most exciting or best exit you've had? And is there any story behind that you'd like to share with our listeners?
Yeah, so I think our most exciting companies have grown so much, and it takes time that, of course, they haven't exited yet. So most of our true exits have been more mid-sized that are a little bit less exciting. It's like the two companies that people often want to talk about. One is Compass, which is the technology-enabled real estate brokerage that's backed by SoftBank. They've raised over $1 billion. I think their latest valuation was $4 to $6 billion. And the other one is Transfix, which is sort of a marketplace for long-haul trucking. They're often called the Uber for trucking. So they're connecting, shippers, Fortune 500 companies on one side with carriers and independent trucks on the other side. We invested, it was actually my first investment in mid-2014. They've gone on now to raise about $100 million from folks like Canvas and NEA, the Australian Sovereign Wealth Fund, and their latest valuation is just shy of $1 billion as well.
And when you look back on those two investments, the founders, did you really like the idea? Did you really like the founder? What was the big thing that you jumped on with those two?
I think Transfix was more the sort of example of what we look for, right? It was obviously like a business model that people were excited about in a giant market, right? Like marketplaces, tens of billions of dollars in long haul trucking fees. So it didn't take a leap of faith to understand that was an exciting opportunity. That being said, we looked at a couple competitors, including one that had like the Silicon Valley resumes. It was 3 Stanford engineers. They were about a year ahead, had a couple $1 million raised. But we thought for this market, you really needed to understand the nuances of both sides of the marketplace. So when we looked at Transfix and the CEO there, Andrew McElroy, he had built his parents' traditional freight brokerage business to like a $40 million revenue business. And we thought he had an advantage in speaking to and building out product for both sides of the marketplace, which are very different customers. On one hand, you have chief logistics officers of Fortune 500 companies. On the other side, you have Joe Trucker, right? And understanding how do you build out the nuance of the product, things that maybe aren't even revenue generating, but like where are the rest stops? Where are the local poker games? How do you track your miles? That's what starts the flywheel in the marketplace. So fast forward to today, I gave you the numbers. Transfix is doing some big numbers. The other company that was ahead with the Stanford engineers went out of business a couple of years ago.
Wow. Well, that has to make you feel good. Well, we're running short on time, and I just in wrapping up here, David, I'd be curious, anything you want to share with our listening audience in terms of, from an investor, if you were an angel investor, an active angel investor, I mean, you're an investor, obviously, but you're more institutional. Any advice, any words of wisdom you'd like to share, lessons learned? Our audience is always interested in that.
I think it's just basically the same advice I have for founders, for institutional fund managers, for angel investors, right? It's be really thoughtful about your plan, why that plan is right for you, even though it may not be right for somebody else, and stick to it. I think we sometimes, especially in the investing world, there's this culture of like always doing more and different before you actually perfect sort of your core practice. So if you come from a certain industry and you think you have an advantage in a network there, just do that for a period of time and master it before you start chasing shiny objects and start looking at different stages or different sectors.
Focus, right? Don't try to be all things to all people. Right. Well, that's great advice. David, thank you so much. Really appreciate your time today. Continued success. And to our listening audience, thank you for joining us. We'll be back again in another few weeks with another podcast. This has been Tom Wallace, Florida Funders. And if you're interested in learning more about Florida Funders, just go out to our website, floridafunders.com. And we always have deals up there, exciting companies if you're interested in becoming an investor, and happy to have you join our community. So thanks again, David. Have a great day and all the best.
Thank you, Tom. This was fun.
Okay, take care.
Florida Funders is an early-stage venture capital firm that blends a venture fund and a crowdfunding platform. They are investing in some of the most exciting early-stage technology companies in the state of Florida.